This is Kurt Heisinger, accounting professor at Sierra College and author of Managerial Accounting. This video describes in detail how to prepare the statement of cash flows. This is a fairly lengthy lecture, so feel free to pause at any point and take a look at the detailed information since there's going to be so much here. The starting point is to look at the information that we need to prepare the statement of cash flow. So we do need to have the balance sheet, and this is the example that we're going to be using here. It's for Home Store Inc. You'll see that up at the top here, the balance sheet for Home Store Inc. For 2 years. And I'm going to repeat this balance sheet. You'll see it in multiple places throughout this lecture. But you need to have the balance sheet as a starting point. And I want to point out that the focus, at least initially, the focus of the statement of cash flows is to explain why cash in this example went down by $98,000. It just depends on the company. It could be that cash went up, it could be that cash went down, but the idea behind the statement of cash flows is to describe why the change in cash. And so what you see here is that in 2016, the most current year, at the end of the most current year, we have a cash balance of $32,000. We ended the year last year, which means we started the current year with $130,000. So you can see that cash did indeed go down by $98,000. So we want to explain why that happened. And so we need this balance sheet and the information on this balance sheet to help to explain that. We also need the income statement for the current year that we're going to be focusing on. So that's what you see here is the income statement for Home Store Inc. for the year ended December 31, 2016. Again, I'm going to include this income statement throughout several different slides, so we'll come back to this and talk about how we use it to prepare the statement of cash flows. I have a separate video that describes the 3 different sections of the statement of cash flows: the operating activity section, the investing activity section, and the financing activity section. It's usually in that order. And so we're going to start here by talking about how to prepare the operating activities section of the statement of cash flows. And yes, there is a lot of information here, but really what I have here is the income statement. That's what you see right here, the income statement that we just talked about on the previous slide, and the balance sheet. Don't worry, I'll zoom in when we need to look at the details. And then up above, we have what the operating activities section looks like. So let's zoom in a bit on this operating activities section just to give you a sense of the information that goes in here. You'll see that we start in the operating activities section with net income. And by the way, this is the indirect method, which is the method that most companies use, meaning we indirectly get to the cash at the bottom here provided by operating activities by starting with net income at the top and then making some adjustments to get from the accrual basis, which is net income from the income statement, to the cash basis, which is the bottom of this section of the statement of cash flows. So we start with net income. I don't put dollar amounts in yet. We'll see that on the next slide. We start with net income, and that's going to come from this right down here from the income statement. Right, so let me just kind of go back here. You'll see what information I provided. That comes from the income statement there. And then we will make some adjustments that come from the income statement. So we're going to add back any expenses that do not impact cash. And the 2 that are most common are depreciation related to our long-term assets and amortization related to our intangible long-term assets. So those are non-cash expenses that were deducted to get to net income at the top here. And so we need to add those back in because they're non-cash, and we want cash activity only. Then the second adjustment, that's the first adjustment, is we want to add back any losses that we see in the income statement or deduct any gains in the income statement that are related to investing activities. So for example, if we sell a long-term asset, a building, and have a loss, we want to add that back because that doesn't belong here. It's not related to the day-to-day operations of the business, not unless we're in the business of buying and selling buildings, and we're not here. And we want to deduct any gains. So let's say we sold a building and had a gain. That's going to be added in the income statement to get to net income up here, and so we're going to deduct it to get that out of here because it doesn't relate to our day-to-day operations. And then lastly, we're going to add and subtract changes in current assets and current liabilities. And I'll talk much more about that in just a minute. Okay, so now we'll actually take a look at some numbers. Let's do this in detail. This is the operating activities section for Home Store Inc., and we're going to be using this example throughout this video. At the very top up here, you will notice that this is the completed operating activities section of the statement of cash flow. Remember, there are two other sections, but we're just focusing on the operating activities section right here. You'll see bottom left the same income statement down here for Home Store Inc. And you'll see also the balance sheet for Home Store Inc. A lot of information here, but we'll work our way through it. So let me focus in here on this operating activity section. We're going to be going back and forth here so you see where this information comes from. And you'll see that we start with net income of $124,000. So I'm going to zoom in and out here so you can see where that comes from. You'll notice that that $124,000 comes from right down here bottom left. That's this number right here. It comes from the income statement, right? That's my net income. So that net income goes to the very beginning of the operating activity section of the statement of cash flows. And then we're going to make some adjustments. So you'll see up at the top that we are adding back the depreciation expense. And so if you look at this income statement, if you look at the income statement here, you'll notice that we have depreciation right here of expense of $24,000. And so that $24,000 is added back up above. It's deducted on the income statement. It's an expense, but it's non-cash, does not affect cash. So we're going to add it back to net income up here at the top. And you'll see that right here, this $24,000. You'll also see that we add back the loss on the sale of equipment. And so if we go down to the income statement once again, you're going to see that we have right here a loss on the sale of equipment of $6,000. Well, that relates to a long-term asset. It does not relate to the daily operations of our business. And so we want to basically take it out of here, meaning add it back, because we deducted it. We want to add it back up at the top. Get that out of there. So let's go back up here to the top, and you're going to see that we indeed add back the loss on the sale of equipment, and that is right there, $6,000. Okay. So now we're going to start looking at, those are the first two adjustments we talked about in the previous slide. Now we're going to take a look at the adjustments related to current assets and current liabilities. So let's turn our attention to the balance sheet, which is over here bottom right, and current assets will be the first piece that we'll be looking at. That's this section right here, and then we will also be looking at current liabilities, and we'll zoom in on this in just a second. The part that I want you to focus on before we go over to the balance sheet is that we need to follow the adjustment rules right here. So the key is to understand the change in current assets and the change in current liabilities and how those changes then are reflected up here in the operating activity section of the statement of cash flows. And that is described right here in this box. So for current assets, let me zoom in on this. For current assets, the adjustment is in the opposite direction of the change in the account. So if, for example, accounts receivable goes up, we're going to show that as a deduction in this section up above, as an adjustment in one of our adjustments up above. So if, for example, let's take another one, inventory goes up, we're going to see it as a deduction up here, and that's exactly what's happening, right? We saw that accounts receivable indeed did go up, and so did merchandise inventory, and therefore the adjustments were downward in the operating activity section of the statement of cash flows. And the reverse is true as well. So if accounts receivable went down or merchandise inventory went down, the adjustment would be added, it would be an increase in this section. And then you see the prepaid expenses, that's also a current asset. So we saw a decrease in prepaid expenses, and therefore we show it in the opposite direction because it's a current asset. It's an increase in this operating activities section. I don't have time in this video to describe why that's the case, but your textbook will very clearly indicate exactly why that's happening. So here we're just going to simply state the rules. And then for current liabilities, back to this box here, the adjustment is in the same direction as the change in the account. So if we have an increase in accounts payable, which we see in the balance sheet down below, so let me go back down to that. So if we have an increase in accounts payable, and that's what we see right here, an increase. It went from 15,000 to 16,000, so an increase of 1,000. Then we're going to show that up above as the adjustment up above will be the same. It will be an increase, and it was $1,000. If we have a decrease, which you'll see on the balance sheet in income taxes payable or any current liability, then it's going to be shown in the operating activities section as a decrease as well. That adjustment will. So again, very, very important rule right here. I'm going to make a mess of this entire slide, but that's okay. This is very important. This rule right here is related to current assets and current liabilities. So for current assets, the adjustment is in the opposite direction of the change in the account. And for current liabilities, the adjustment is in the same direction as the change in the account. So we now have all of our adjustments shown here. And what that tells us is that the company, when it's all said and done, that the company received $22,000 in cash for the year related to daily operations of the business. So they didn't receive $124,000, that was net income, but it's on an accrual basis, that's not cash. They received $22,000 in cash related to the daily operations of the business. So that is the first section of the statement of cash flows, and tends to take the most time to prepare. That's why I spent some time on this slide. Okay, the second step then is to prepare the investing activities section of the statement of cash flows. And so this step focuses on the effect that the changes in non-current assets have on cash. So anything, for example, that's a non-current asset, like a building or property, or maybe we get an automobile, or we purchase some land or sell some land, any cash activity related to our non-current assets will appear in this section. And the non-current asset balances can be found on the balance sheet. We have to go look at that to figure out exactly what that impact might be on cash. And typically we've got to go track down some additional information. It's not all going to be on the balance sheet. We're going to have to go find, for example, cash proceeds from the sale of equipment, and that's not something that's going to be specifically on the balance sheet. So we have to go to the accounting records to get that information. And in a textbook setting, you'd have to be provided with that information. This section then will show the cash either provided by, meaning it's going up, or used by, meaning it's going down, the investing activities. After going through the records for Home Store Inc., then we discovered, in putting together the investing activities section, that the company purchased equipment and paid cash of $67,000. Remember, we might be financing part of that purchase, but we really only want to know how much cash went out for the purchase of the equipment. And from our records, from our accounting records, we saw that cash went out of $67,000. So we credited cash in that transaction for $67,000. We also had proceeds from the sale of equipment, and again, we have to analyze the equipment account in detail to get this information. And we identified that we actually received cash of $5,000 related to the sale of our equipment. So we paid $67,000 for some equipment that we purchased, and we received $5,000 for some equipment that we sold. We also purchased some long-term investments, which means cash went out as we purchased them, totaling $12,000. And again, these are all related to non-current assets. And the result then is that the company used $74,000 in cash for investing activities, meaning that cash went out, totaling $74,000 related to non-current assets. The third section of the statement of cash flows is the financing activities section, and this is step 3. The focus here then is to determine what effect the activities related to non-current liabilities and stockholders' equity have on cash. And it's performed, this step is, by analyzing the information that's associated with non-current liabilities and stockholders' equity. We're going to have to take a look at the activities, cash activities, related to those two areas on the balance sheet to identify exactly what happened with our cash for financing activity purposes. And ultimately, this section will show the cash either provided by, increase, or used by, decrease, the financing activities. So let me show you an example of this on the next slide. So what you see here at the top of this slide, this is the financing activities section of the statement of cash flows. So this would appear right after the investing activity section. I'm going to show you the whole thing at the end here, but we're piecemealing it right now. This is the financing activity section for Home Store Inc. And it shows us that, and I have the balance sheet at the bottom here, so we can tie it back into that if you like, but it shows us that the company paid principal payments on bonds of $18,000. So that's $18,000 in cash that's going out. It also shows us that we issued some common stock. Remember, it's non-current liabilities and owner's equity, so that's where these all relate to. That we issued some stock and received $4,000 in cash, and that we also paid cash dividends, and that's cash out to our common stockholders, and that's cash out of $32,000. So let me tie this to the balance sheet that you see down below. Let's start with that principal payment on bonds of $18,000. You'll see down here that we have bonds payable, and that balance went down from $105,000 to $87,000. So it went down by $18,000, which means that we need to show it as a payoff, as cash going out up above of $18,000. So show you that up above. And so you'll see up here that $18,000, it's right there. That's our cash reduction related to the payoff of those bonds. And then let's take a look at one more line item. We also issued common stock, and you'll see that down here. We issued common stock, and we reflect that here. That the stock balance went from $410,000 to $414,000. So it went up by $4,000. And so if we go up here, you'll see that right here in this slide, the second line item. The second line item shows that stock went up by, or that rather cash came in, so we issued stock, cash went up by $4,000. And then we paid cash dividends, and we'd have to go track that down in our records, but we paid cash dividends of $32,000 as well, and so that's cash out. And what that means overall is that the company used $46,000 in cash for financing activities. Okay, so now let's compile all this together. This is step 4. Let's put the entire statement of cash flows together and make sure that we've explained the entire change in cash in this example for the year that we're looking at. So this is the entire statement of cash flows. It's for the year ended December 31, 2016. And you'll see, if you want to tie this back to previous slides, you'll see here that step 1 is shown right here, and we did that. I gave you all the details of where that came from. Step 2, that's shown right here. So step 1 is the operating activity section. Step 2 is the investing activity section. Step 3 is preparing the financing activity section. And now we're looking at step 4, and also a compilation of the entire statement of cash flows. So in step 4, it's very important. It's shown right here. We're just simply reconciling what happened to cash from the beginning to the end of the year. And that information is shown at the very bottom, right here. The number I want you to take a look at to start is this $98,000 decrease. That is simply a culmination, or I should say a sum of the three numbers you see up above. So that's this 22,000 plus a positive 22,000 minus the 74,000 minus the 46,000, and that nets out to a negative or minus $98,000. And now what I want to show you is that ties to the cash line item right here, and that's the critical piece to this, is that we actually identify why cash went from $130,000 to $32,000, and the details of why cash went down are shown in this statement of cash flows right here. So this provides the detail for that decrease of $98,000. And at the very bottom, we're simply reconciling that by taking the cash at the beginning of the year. That's this right here, cash at the beginning of the year of $130,000, and we're going to subtract the 98 from that to show that at the end of the year we had $32,000. So this is the entire statement of cash flows in this example for Home Store Inc. This may already be obvious, but I still want to point it out nevertheless, that all positive amounts that you see on the statement of cash flows denote an increase in cash. So cash is going up if it's a positive number. So anywhere on the statement of cash flows, when you see positive amounts, that means an increase in cash, with the exception of step 4. And then in step 4, you just see balances at the very bottom. And then negative amounts denote a decrease in cash. So if it has brackets around the number, that means that whatever that line item is, it's resulting in a decrease in cash. And then there's one last piece that we need to talk about. If there are any significant non-cash investing and financing activities, those transactions are not shown in the statement of cash flows. An example of that would be issuing common stock and receiving a building in return. But they don't affect cash, so they are not presented in the statement of cash flows. So it's important to note, though, that if the transaction is significant, that it should be disclosed in the notes to the financial statements.